Welcome to Talk Tickers. Today, we're digging into Amphastar Pharmaceuticals' latest earnings report. Now, on the surface, it looked like a solid beat. So why on earth did the stock drop right after the announcement? Well, stick around because we are going to unpack the hidden details that Wall Street seemed to miss at first glance.
All right, here's how we're going to break it all down. First, we'll look at those headline numbers that seem so positive. Then, we'll solve the mystery of that initial sell-off. After that, we'll dive into the company's game plan for future growth, see how the market eventually caught on, and then we'll wrap it up with our take on the next call, a potential trade idea based on everything we find.
Okay, first up, the headline performance. On paper, Amphastar put up a really fantastic third quarter. The kind of report that you'd expect to send the stock flying high.
So get this, they reported adjusted earnings per share of 93 cents. That didn't just beat the Wall Street consensus, it comfortably sailed past it. The street was only looking for about 83 cents a share.
And it's the same story on the top line. Revenues clocked in at $191.8 million. That's about a 4% beat over what everyone was expecting. So far, so good, right?
And here is where the story starts to get a little more interesting. So yes, they absolutely beat expectations. But take a look at that column on the far right. The year-over-year growth. It's basically flat. This is really our first clue that there's something else going on just beneath the surface of those headline numbers.
So that brings us to the big question. If the results beat expectations, why in the world did the stock tank at first? We've got to get to the bottom of this.
Yeah, this was the question on everyone's mind right after the release. You've got a solid beat on earnings, a beat on revenue, so why did the stock sell off a full 4.3% on the day? The answer, it turns out, is all in the accounting. And here it is, it all comes down to some really messy optics. See, the official GAAP earnings were only 37 cents a share. That number was dragged way down by a huge one-time charge for litigation, and that's not really part of their core day-to-day business. The non-GAAP number, the 93 cents, that gives you a much clearer picture of how the actual business is doing.
So the bottom line is that these one-off items just absolutely crushed their margins. This chart says it all. You can see their operating margin just plummeting from a super healthy almost 30% last year down to just 13% this quarter. And that, right there, is the kind of scary number that spooks trading algorithms and anyone who's just scanning the headlines.
Okay, so once you filter out all of that accounting noise, you can finally focus on what management really wanted investors to see in the first place, the future growth story.
And the growth engine is crystal clear. It's a product called BAQSIMI. Revenue from that grew an incredible 33% year over year, and now it makes up almost a third of the entire company's sales. This is exactly what you want to see, a new product offsetting the expected declines in some of their older legacy drugs.
And this is the real pivot point. Management was clear. 2025 is going to be a flat kind of transition year. But, and this is a big but, they're targeting a major re-acceleration in 2026, aiming for high single-digit, maybe even low double-digit growth. That's the story they want you to focus on.
And that growth isn't just wishful thinking. It's backed by a pipeline that is just packed with potential catalysts. They've got a key FDA decision coming up for a drug called teriparatide before the end of this year, and then another potential big launch in the first half of 2026. This is where that future growth is going to come from.
So, how did the market handle this? This whole story of messy short-term numbers versus a really strong long-term outlook? Well, let's just say it took a few days for it all to sink in.
It was definitely a journey. The stock took that 4.3% hit on earnings day as the market freaked out about the margins. But then, as analysts and investors actually listened to the conference call and digested the details, it came roaring back, gaining 12% over the next few days.
And pretty soon, analysts started to see the light. Stock Story, for example, called it simply the best report in the entire sector. And this just confirms our whole theory here. Once the market looked past those one-time charges, it finally recognized the underlying strength of the business.
Okay, so let's put it all together. What does this all mean for the stock going forward? This brings us to the next call, where we'll explore a potential trade idea for the coming quarter.
So looking ahead, what's the most likely path for the stock from here? Well, it really boils down to a classic Wall Street story. Can their future potential outweigh their current challenges?
Let's break down the bull versus the bear case. The bulls are basically betting on two things. First, a successful FDA approval for that new drug, teriparatide, and second, that their growth engine, BAQSIMI, keeps up its incredible momentum. The bears, on the other hand, are worried that the older products might fall off a cliff faster than expected, or that another surprise litigation charge could pop up.
So given that the stock has been a pretty severe underperformer for the past year, but balancing that against these very real, very near-term catalysts, we're assigning it a market perform rating. The turnaround story is definitely compelling, but the risk that they don't execute perfectly is still pretty high.
Okay, so for a specific trade idea, and look, this is definitely for more advanced investors, you could look at something called a bull-put spread. Let me explain the logic in simple terms. The whole idea is that the market isn't fully pricing in that big FDA decision coming up. This strategy basically lets you collect a little bit of cash up front for making a bet that the stock will not fall below a certain price by the time the FDA makes its call. It's a way to be moderately bullish while also strictly defining exactly how much you can possibly lose.
This is not financial advice.